I don't care at all about the movement of gold from $2,000 to $2,150 or $2,200. I own gold personally because I'm afraid it's going to go to $7,000 or $8,000. The move that we've seen so far may be the end of the move. I don't know. That's not why I own gold. Really, truly do not own it because I think it might go to 2,500. Momentum in a precious metals market is established by gold, perhaps because the fear buyer is more motivated than the greed buyer after gold has moved. In the middle of a gold bull market, when the narrative has been established by gold, silver, perhaps because of its lower unit price, moves later. It moves further and it moves faster once it moved.
RickRule, representing Rule Investment Media, reiterates his steadfast belief in gold as a reliable hedge against economic uncertainties. He emphasizes its enduring value amidst short-term market fluctuations, even amid the prospect of exceeding the $2,500 threshold. Meanwhile, Natasha Kaneva, a JPMorgan Chase Incorporated spokesperson, maintains an optimistic stance on gold, envisioning a possible ascent to $2,500 following its recent record peak of $2,195.15. However, she advocates for caution against excessive exuberance within the market. Gold prices experienced a slight decline on Monday, attributed to a firm dollar and anticipation of policy decisions from major global central banks, including the U.S. Federal Reserve. Spot gold dipped 0.4% to $2,147.89. Geopolitical tensions, including the Russia-Ukraine conflict and unrest in the Middle East, are expected to support gold's safe haven status. RickRule explains that the recent increase in gold prices reflects a delayed response to ongoing favorable conditions such as negative real interest rates, inflation, debt, and deficits. Meanwhile, silver is trading at $25.18, showcasing a notable 1.49% rise from the previous session. Its breakthrough of the daily pivot point at $24.79 suggests the possibility of sustained upward momentum. RickRule observes that gold typically takes the lead in bull markets initially, with silver trailing behind. However, as momentum strengthens, silver often surpasses expectations, albeit requiring time to do so. Looking ahead to 2024, silver's performance is expected to be significantly influenced by geopolitical tensions, including the U.S. presidential election and monetary policy decisions made by the Federal Reserve. Capital Economics forecasts a stronger performance for silver in 2024, attributing it to anticipated growth in industrial demand, potentially reaching the $27 mark. Join us as we delve into RickRule's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
I think you are starting to see a movement in the gold price, and I think it's delayed. I think the circumstances that are conducive to a move in the gold price have been around for 3 or 4 years. They're not new, but the response to the market is new. People's expectation of the future is set in the immediate, not the distant past, and not around history. We've been through 40 years of benign economic climate, ending, I believe, in 2022. And I think it's taken the market a while to react to negative real interest rates, to inflation, to debt and deficits. And I think it's that dawning realization, particularly among non-US centric central banks, to understand that gold is an important portfolio diversifier. And Ivan, I want to say right now that as an investor myself, as a speculator, I don't care at all about the movement of gold from $2,000 to $2,150 or $2,200.
Right.
I own gold personally because I'm afraid it's going to go to $7,000 or $8,000. The move that we've seen so far may be the end of the move. I don't know. That's not why I own gold. I don't own it as a trading sardine. I own it as an eating sardine.
Yeah, that's right.
And I really, truly do not own it because I think it might go to 2,500. So let's talk about that. Let's get that out of the way, first of all.
Right.
The frustration around the silver speculators has occurred for as long as I have been on Earth. I don't know why. I have my suspicions. Momentum in a precious metals market is established by gold, perhaps because the fear buyer is more motivated than the greed buyer.
Right.
After gold has moved. Then, in the middle of a gold bull market, when the narrative has been established by gold, silver, perhaps because of its lower unit price, moves later. It moves further and it moves faster once it moved. But in every market that I've been around, except for the false breakout the sort of Reddit precious metals breakout
Right.
in 2020, when the speculative stocks led all the commodities. I've never seen a market where gold didn't have to establish the momentum and silver to fall in. Make no mistake, in my experience, and I've been through several bull markets, if the momentum gets established by by gold, silver will exceed all but the greediest of expectations.
Right.
It'll just take a while. Now, let's go to the delta between the metal performance and the share price performance. First of all, this is consistent with all prior bull markets. The metals have to lead. It's important to know that when the metals lead, there's a lag. In the case of the gold price moving up from, say, a year ago at $1,850 to $2,150, what people need to understand is that although the gold prices moved up, the prices of consumables, the prices of the cost of producing gold has also moved up.
Oh,
So the
really?
margins haven't moved up in lockstep with the gold price. It's important to know that. If you look at the cash flow statements, the quarterly cash flow statements of major gold producers, although the gold price has moved up, it hasn't yet been reflected.
Rule emphasizes that despite notable increases in gold prices during certain periods, many gold mining companies have failed to deliver satisfactory performances. During October, gold reaffirmed its status as a reliable safe haven asset, offering protection against market turbulence, volatility, and geopolitical uncertainties. By month end, gold settled at $1,983.88, registering a notable gain of 7.32%. Interestingly, while gold prices soared, gold mining stocks initially followed suit but faltered as gold approached the $2,000 threshold. This unexpected loss of momentum led to a retracement of half of their earlier gains. Despite this, both the NYSE Arca Gold Miners Index and the MVIS Global Juniors Gold Miners Index still managed to record gains of 4.2% and 3.8%, respectively, during the month. However, the significant underperformance of gold stocks compared to the precious metal has widened the valuation gap between them. Let's get back to the interview.
The ugly truth, too, that's really important for your listeners to understand is that the historic performance of the sector as companies, not as gold companies, but as companies, has been dismal.
Yeah.
In the year 2000 to 2010, the decade, pardon me, the gold price goes from what, $250 to $1,900, a seven-fold increase, and the free cash flow per share of companies on the Philadelphia Gold and Silver Index fell. It took skill to turn a seven-fold increase in the selling price of the commodity into a decrease in free cash flow. Now, my hope is that the managements who presided over that have all been thanked and excused.
Right.
And investors are holding the industry to higher account. But my suggestion to your listeners is that their first investment in gold and silver has to be in themselves. Because if you invest in the sector itself over 2 decades, you will go broke.
Wow.
You need to invest in individual people, in individual companies. Because about, I don't know, maybe 20% of the majors and maybe 3% of the juniors generate enough performance that they add legitimacy and even luster to a sector that's performed as horrifically as mining has in the past. People need to invest in scale. Everything that can go wrong with a big mine can go wrong with a small mine, but a small mine can never make you big money. Too many investors screw around with stuff that doesn't matter. And small mines don't matter. If you're going to take big risks for big money. Specifically, if the target doesn't have an in situ value of recoverable minerals exceeding $2.5 billion, say a 1 million ounce gold deposit or an 80 million ounce silver deposit, don't bother.
Right.
Just don't bother. Then it becomes all common sense. In the exploration business, really what you're doing is employing technology to answer unanswered questions. What's the most important unanswered question? How long does it take? What's the probability of a yes answer? What's a yes answer worth? How much money will it take? And do you have enough money to get me to a yes answer? This is common sense.
Right.
Most speculators employ a strategy called got a hunch, bet a bunch. They assume because silver is on the name of a share certificate somewhere that the company has silver rather than looking for silver. If the silver price goes up and you don't have any silver, what difference does it make?
Yeah, nothing.
None whatsoever. That's how people need to invest in themselves.
The U.S. Federal Reserve's interest rate decisions are anticipated to influence the near-term trajectory of bullion prices. Additionally, the escalation of geopolitical tensions and political uncertainty could bolster demand for gold in the futures market. How do market observers anticipate the Federal Reserve's interest rate decisions to impact the near-term trajectory of bullion prices, broader economic indicators, and investor confidence? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.